Colleagues, it's my pleasure to rise today to speak at third reading of Bill C-69, the Budget Implementation Act 2024. However, I need to start by echoing the comments of Senator Tanis from his speech at second reading yesterday. At some point, this chamber needs to push back on these omnibus bills. It is entirely unreasonable, irresponsible, in fact, for the House to deliver two omnibus bills at the 11th hour, totaling 1,209 pages, with an incredible diversity of complex legislation, and for the government to expect us to deliver the entire two omnibus bills on their schedule. These omnibus bills keep being stuffed with highly consequential legislation that is egregiously non-budgetary and non-economic in nature. For me, the inclusion of consequential changes to the Election Canada Act last year in Budget Implementation Act of 2023 is a prime example. I continue to be deeply troubled that one of the only things that our three largest political parties can agree on is to limit their responsibility in protecting the data rights and cybersecurity of Canadians. They did this as the rest of the world has been strengthening data rights and security, and they hit it on the last page of an omnibus bill. Our collective unwillingness to stop this from happening again and again, year after year, is something we all need to seriously reflect upon. Where and when do we draw the line? And I'm not missing the irony that this year I'm celebrating highly consequential changes relating to competition, banking, and money laundering that are contained in two omnibus bills, C-69 and earlier this week in C-59. I comfort myself in the knowledge that these measures were actually described in the budget speeches and that they relate to pressing economic issues and are beyond long overdue. But I can't help but wonder how much I'm adding to the problem by lending my support. I have enormous respect for the work we do, but we're starting to get, I think, a strong message from the government that its respect has limitations and that are making it increasingly difficult for us to do our job. This issue was best illustrated in the C-69 technical briefing. 4 finance officials were available to answer questions on 500-odd pages, making up the first three parts of the bill. When we moved to Part 4 and its 44 divisions of various measures, covering 150-odd pages, the 4 finance officials left and were replaced by a steady stream of dozens and dozens and dozens of officials squeezing into the committee room. This standing room-only meeting had 60 or more officials representing 24 or more different departments and agencies. Talk about a visual representation of an omnibus bill. Colleagues, we have a problem, and I hope we choose to address it. With that off my chest, I want to add my voice on to two parts of C-69 where this government is finally taking some incredibly long overdue action. Consumer-driven banking in Part 4, Division 16, and amendments to the Proceeds of Crime, Money Laundering and Terrorist Financing Act, or PCMLTFA, try that 3 times, in Division 34, Subdivision A. I'll begin by focusing on the new piece of legislation included in Division 16 called Consumer-Driven Banking, and including changes to the Financial Consumer Agency of Canada Act. Now, this may sound like a bit of a trigger warning, but I need to apologize in advance to colleagues who have heard me speak often and repeatedly about open banking over the last 5 years, because I'm going to be doing it again. It's just the government has changed the name to Consumer-Driven Banking. Consumer-driven banking simply refers to the rights and procedures that give consumers control over their personal financial data and the ability to safely share those data with an accredited service provider who they believe will offer them a valuable service. It also could simply involve moving their money from their current financial institution to another bank or financial institution, or moving their data from a non-bank to a non-bank that offers specialized services that are valuable in the minds of that customer. The social and economic benefits of consumer-driven banking are transformative for consumers and small business. How? What if you're fortunate enough to have some money in your checking account, but your bank does not give you any interest? Wouldn't it be nice if you could instantly get competitive quotes on multiple CIDC-insured institutions without having to visit a branch or make a phone call? Let's say you're applying for a loan. They have to repeatedly complete the same forms at each financial institution. Wouldn't it be nice if an organization with access to the necessary information versus filling out long forms repeatedly, if you could use that and get quotes from multiple organizations almost instantly versus just one? What if you've only been able to afford to rent a home and are saving towards buying one? Wouldn't it be great if your credit score could reflect your years of reliable rent payments, especially when in some cases, these rent payments are just as big as mortgage payments? What if you struggle to budget and understand your cash flow? Wouldn't it be great if you could automatically monitor your income and payments and monthly commitments in a way that gave you control over your financial situation, reduce the risk of missing payments, and help to have the information that might help at that particular moment when you're about to make an impulse purchase? Well, all of these innovative, intuitive, and easy-to-use financial technologies already exist in Canada. They're being used by over 9 million Canadians today, but without a secure and regulated data sharing framework. The market has moved, but the minister who governs our financial regulators has not until now. Consumers accessing financial technology services have been using a workaround called screen scraping, where data from their online banking statements are accessed in an insecure manner with no liability framework to protect them. Canada's critically elevated levels of regulatory stagnation introduce unnecessary cybersecurity risks to these Canadians that luckily have not materialized as yet. Our Banking Committee reported and focused on this issue 5 years ago in June 2019. Suffice to say, when this government first committed to moving forward back in 2017, Canada was considered a leader, following quickly on the coattails of the pioneer, the United Kingdom. After initial delays, we aspired to become a fast follower. Some of the more naive among us, a group that often includes me, found hope when the Liberal Party followed the Conservatives and included consumer-driven banking in their 2021 election platform and promised to implement it by January 2023. 7 long years and 3 comprehensive consultations later, we are finally seeing the very first legislative action on this matter. As a result of all this political inaction, Canada is now firmly in the category of global laggard. I now see that all G7 countries and over 50 other countries have implemented various forms of open banking, with many moving on to versions 2 and 3 of their implementations. So what is included in this first legislative package? Our Banking Committee had the opportunity to conduct a pre-study into the matter. Our witnesses included officials from the Competition Bureau, the Financial Consumer Agency of Canada, the Canadian Bankers Association, Desjardins Group, Payments Canada, and 2 financial technology spokespeople. While I'm glad that Canada has finally taken this tentative first step, our Banking Committee had numerous concerns with some of the foundational structures presented, concerns which I believe we reflected accurately in our observations to the Senate's National Finance Committee. In particular, the Banking Committee observed that, and I quote, "Having a strong governance structure will be essential for the regulator so that Canadians can be confident when participating in the consumer-driven banking regime. The committee has serious reservations over the government's decision to designate the Financial Consumer Agency of Canada, or FCAC, as a regulator for consumer-driven banking, and questions why a more robust independent regulator that has expertise in enforcement was not chosen." Why is this observation important? The first recommendation in our Banking Committee report from 2019 suggested that the FCAC play an interim role as an oversight body for screen scraping and open banking activities within the federal jurisdiction and to respond to complaints. The intention was for them to play an immediate transitionary role until a final regulator was identified. However, we worry that the organization may not be equipped or have the right skill set and culture to take on a full-time regulatory role in this field. Personally, I also worry about giving a financial regulator the first responsibility for sharing consumer data, and then it's a siloed approach. It does not ensure that the banking provides a stepping stone to giving consumers control over all their personal data, like health and energy, as is the case in countries like Australia and the United Kingdom. Just doing financial information alone in a silo doesn't help us get into other areas that are really important to driving efficiencies and innovation into our economy. The fact that the FCAC is a federal regulator also brought up jurisdictional concerns with several Quebec senators, worried about potential confusion as to which regulatory body will receive and handle complaints. We are hopeful that Finance Canada has consulted on this matter and will work to resolve this uncertainty. Last, the legislation allows for the Minister of Finance to select a standards-setting body which will be in charge of overseeing the technical standard that is used to share data under what's called a Application Programming Interface, or API. This API will be the heart of the data transfer system. Speaking to the importance of having an independent body responsible for overseeing data transfer was underscored by the Competition Bureau in their testimony. Specifically, they identified that independent governance is crucial to success. Deputy Competition Commissioner Anthony Durocher's testimony spoke to the fact that a lack of independent governance, and I quote, can be death by 1,000 cuts if there are numerous ways for the system to be undermined. Governance is a key issue. We want to make sure that the entity or the people who control the pipes have the public interest at heart rather than any specific private interest being at play, end quote. Good governance is critical because the technical standard used will control all data sharing. Early and consistent indications have shown that big banks are highly capable of tilting the scale in their favor. So yes, this is a real risk. In committee, the Canadian Bankers Association stated that they are in favor of one specific organization becoming the technical standards body at the core of this new, quote-unquote, made in Canada, consumer-driven banking regime. Their preferred organization, called FDX, reports to an American board of directors dominated by American banks, and needless to say, this caught the committee's attention. The loss of sovereignty and control over the technical standards governance would be concerning. It is also contrary to the principles outlined in the bill in Clause 198.82, which includes ensuring, and I quote, safe, secure, and efficient sharing of data among participating entities, end quote, and also, quote, fairness, accessibility, transparency, and good governance, end quote. Our Banking Committee strongly recommended avoiding such potential conflicts of interest. Our choice was to include a recommendation that made it very clear if the minister chooses to use this made in Canada technical standard controlled by big American banks, some Canadian big banks, and one rotating non-voting representative of American consumers, then the minister should ensure that the governance structure of the technical standards body is entirely and completely independent of those who control the technical standard itself. This would reflect the all-important advice of our Competition Bureau. I look forward to seeing the next steps in this regime in the fall and the full implementation of not just read but write access to unlock the full value of consumer-driven banking in Canada for Canadians. I think it's also important to note that any progress that Canada is making is thanks to the excellent work of some incredibly capable officials at Finance Canada. My sincere hope would be that any framework put in place does not remain siloed in the area of financial data, but is forward-looking, enabling Canadians to begin to control their health, utility, and other data. This sort of framework requires the passage of Bill C-27, the Digital Charter Implementation Act, which remains in the House of Commons in due committee. C-27 will provide Canadians what is called data mobility rights, which grant them control over their data, and this has rapidly become the global standard. My sincere hope is that C-27 will find its way to us here in the Senate in the fall. I also want to touch on very positive amendments made in Part 4, Division 34, subsection A, relating to private-to-private data sharing to combat fraud, money laundering, and other illicit activities. Colleagues, Canada continues to face challenges in combating money laundering and terrorism financing. The resulting harms have caused Senators Boniface and Mention to bring a lot of us together on several different occasions to identify ways in which the Senate might help to address this deeply troubling problem. I'm grateful to them for alerting me to the scope of the crisis and introducing me to global leaders in the space. In 2019, the scale of money laundering in Canada was estimated to be approximately $46.7 billion annually, equivalent to about 2.1% of our GDP, or about the size of Nova Scotia's economy. Our past failures to take action have tarnished our global reputation. We've been terribly slow to adopt international standards, but we are starting to catch up with jurisdictions like the UK and EU in terms of beneficial ownership transparency, thanks to efforts that caused the passage of Bill C-42 and other ongoing activities. Canada's globally recognized money laundering problems reach into real estate, financial institutions, virtual assets, corporations, luxury goods, and professions like lawyers. In the last 12 months, Canadian financial institutions like TD Bank, RBC, and CIBC faced investigations and fines related to money laundering violations and their handling of suspicious transactions. TD Bank was fined $9 million by FinTrack, but this is a paltry amount, especially when considering that this Canadian bank is thought to be facing a fine of $1 billion or more for similar failures in the United States. Bill C-69, among other things, enables private-to-private information sharing between reporting entities like banks, including authorized foreign banks, credit unions, provincially regulated loan investment securities companies, and casinos. This can be done without consent under specific conditions. And the reason this is important, colleagues, is that when a bank got suspicious of certain activities, if the customer learned of that or sensed that, they just had to move to another financial institution and got a reboot, because that information couldn't be shared between those two financial institutions. So this is a really important change. But crucially, the process involved Privacy Commissioner Philippe Dufresne early on, and to ensure the application of balanced measures to maintain confidence in the regime. He stated in our Banking Committee, and I quote, "I support the measures in Bill C-69 to facilitate effective information exchange for combating money laundering and terrorist financing." Bill C-69 also empowers FinTrack to disclose financial intelligence, including compliance violations, and the bill also strengthens asset recovery measures by enhancing the powers of provincial and territorial civil forfeiture offices and streamlining the process for returning seized property to rightful owners. Bill C-69 marks a positive step in reinforcing Canada's anti-money laundering, or AML, regime, but it remains just as a start. I continue to focus on two more big steps. First, the fact that Canadian lawyers operate outside of the AML system and are often sought out by criminals for their expertise in setting up vehicles like corporations and trusts for laundering proceeds. This is deeply troubling. Addressing these issues requires closing the gaps related that might allow for lawyers to abuse their professional privilege, possibly by enhancing reporting requirements and strengthening enforcement oversight bodies. Additionally, we need to empower Canada's innovators to help us become global leaders in AML. St. John's-based Verifin has proven this is possible by becoming a multi-billion-dollar company and globally leading innovator in the AML space, providing highly valued services to banks globally. So Senator Marshall is far from alone as a Newfoundland powerhouse in efforts to root out waste, subterfuge, and bad actors. I'd like to speak about several other issues in the bill, but again, the late arrival of this omnibus bill has overloaded our legislative capacity, so I will leave things here and thank you, colleagues, for your attention.